Every quarter, listed companies disclose one interesting piece of information: whether promoters have bought or sold shares in their own company. And you should know, when promoters increase their stake using their own money, it's worth paying attention, because it tells you that the people who know the business best are becoming more confident about its future. So in this video, we are looking at 10 companies where promoters increase their stake in Q1 FY27. For each company, we'll answer 3 simple questions. What does the business do? Why could promoters be buying now? And what are the key opportunities and risks investors should know? But remember, promoter buying alone is never a reason to invest. It is a starting point for research, not the final decision. So let's get right into it. Stock number 1 is MSP Steel and Power. Promoters just bought shares worth 216 crore. That's 9.1% of the entire company's value in just one quarter. So what does MSP actually do? Well, they are a steel company. They mine iron ore, turn it into pellets, then sponge iron, then finally into steel bars which are used in construction. They even run their own power plant and their own railway line, which keeps costs lower than most competitors. The stock is currently valued around 2,350 crore rupees today at about 17 times earnings. Now here's why this buying is interesting. This isn't a story about steel prices suddenly going up. It's a story about a company that quietly fixed itself. MSP just exited something called corporate debt restructuring. Basically, a few years ago, they were in enough trouble that their loans had to be restructured just to survive. That chapter is now closed. Debt has fallen sharply and a fresh 98 crore raise is being used to pay off even more of it. Revenue actually dipped slightly because steel prices were weak this year, but even then, profit margins improved from 5 to 6%. And the company swung back into profit of 34 crore after posting a loss last year. So even while prices worked against them, the business itself got healthier. That's the real story here. But let's not forget, MSP is still a steel company at heart. Prices, raw material costs and construction demand are all out of their control. And there isn't much pricing power in this industry. Now let's move on to stock number 2, Pratik sales. Promoters just bought shares worth 153 crore, about 5.5% of the entire market cap. What do they actually make? Decorative laminates and wall panels. Basically the stuff that covers walls and furniture in modern homes and offices. And it's riding a real wave. More urbanization means more premium housing, means more people spending on how their homes look. But here's the smart part you need to understand. Laminates sound like something anyone with a factory could make, a total commodity. But Pratik turned it into a branding game. They have built nearly 16% market share in the organized wall panel space, and instead of competing on price, they compete on design. It has a market cap of 3,150 crore and the stock is trading close to 38 times earnings, which is a premium price. But here's why that might be justified. This isn't really a cheap commodity business, it's a design and distribution business. They offer over 30 product categories, more than 3,000 designs, and launch over 1,000 new designs every single year, reaching customers through 198 distributors across 138 cities. That kind of scale is genuinely hard for a smaller regional player to copy. On top of that, they keep growing through smart acquisitions. Now let's look at the numbers. FY26 revenue grew to about 335 crore. Operating margins are strong at 34%, though they came down slightly because input costs went up. Net profit stayed nearly flat at 77 crore. Now the risk here is pretty straightforward. This business depends on real estate and home renovation spending. If that slows down, so does this. And raw material costs can swing without warning. Plus, competition from other organized players isn't going away. Now let's move on to stock number 3, Paisalo Digital. Over the last 3 years, promoters first put in 180 crore through warrants and then just kept buying. They added another 4.7% stake in FY26 alone. Paisalo is an NBFC, basically a lending company that isn't a bank. But instead of handing out loans with no backup, most of what they lend is backed by collateral, mainly to small businesses. They ended FY26 with a loan book of around 6,100 crore, which is up 17% year on year, and profit of 237 crore, which is up 19%. Now this is what makes it interesting. This is one of the cleanest loan books in a corner of the market that's usually pretty risky. Gross NPA of just 0.76%, net NPA of 0.61%. In small ticket lending, where defaults are usually much higher, this is an unusually clean book. Collection efficiency is at 98.5%. So how are they pulling this off? Two reasons. First, Unlike most microfinance players who lend without collateral, 93% of their book is secured and they lend pretty conservatively. Now second, they are using AI to make their people more productive, not to replace them. Processing 1.6 lakh loan applications and 2.25 loan collection cases last quarter through AI systems, while their headcount actually fell 3% even as they expanded. Now at around 6,300 crore of market cap and 3.5 times book value, this isn't a bargain stock, it's a growth and quality story. The risk here is a big chunk of the loan book is still concentrated in a handful of states and the NBFC space is brutally competitive. Now let's move on to stock number 4, Stylum Industries. If you have ever walked through an airport or a renovated office, you've probably touched a Stylum product without even realizing it. They've quietly become one of India's largest export-focused laminate makers. In FY26, over 75% of their revenue came from outside India, Europe, North America, the Middle East. FY26 revenue was around 1130 crore, EBITDA margins near 20%, ROE above 20% and ROC around 27%. Now the next big trigger here is they are starting commercial production at a brand new plant around June or July FY27. In its first year, this plant alone could add around 250 crore in revenue and eventually the potential is around 900 crore a year from this one facility. And you know what the best part is? They funded most of this through their own cash, not fresh debt. And this stock is particularly different because the confidence isn't just coming from the promoters. Japan's AICA Kogyo has also become a strategic investor, taking a meaningful stake in Stylum. Now at a market cap of 5,160 crore, the stock trades at around 34.5 times earnings. That's a premium price. The risk here is that with 70 to 75% of revenue coming from exports, currency swings, global demand shocks matter a lot here. And the rising cost of raw material could also squeeze margins. Now let's move on to stock number 5, which is Balrampur Chini Mills. This is the one where the promoters didn't just buy shares, they made sure they wouldn't get diluted. Balrampur Chini raised fresh capital through a preferential issue and promoters put in nearly 193 crore of it themselves, about 1.17% of their market cap, specifically to protect their ownership stake as the company funds its next big move. So what do they actually do? Well, it's a sugar company with 10 sugar mills, 5 distilleries and power generated from sugarcane waste. Sugar alone makes up about 75% of their revenue. The stock trades around 564 rupees and right now the market is largely still pricing it like a plain old sugar business. But here's why that might be about to change. Balrampur is investing 3,000 crore to build India's first large-scale plant for something called polylactic acid or PLA, which is a biodegradable plastic alternative used in packaging, textile and healthcare products. This plant goes commercial in Q3 FY27 and the timing also lines up pretty well. The global PLA market is expected to grow at nearly 12% a year through 2034 and India's own policies are actively pushing companies away from regular plastic. Balrampur also has a natural home ground advantage here since they already have their own sugar supply and their own power, which could make them one of the lowest cost PLA producers in the world. So this could actually stop being just a sugar stock if the transition plays out as planned. The risk here is purely execution. Now the next stock on the list is Ramkrishna Forgings. This one's interesting because right now most investors are avoiding this stock, weak return ratios and high debt. And yet, promoters just bought 141 crore worth of shares in the last month alone. They are infusing 203 crore through warrants and this money is mainly going towards cutting debt after an aggressive expansion across forgings, casting, machinings and railways. Now here's management's actual message to investors. The heavy spending phase is basically done. What comes next isn't more capex, it's finally using what they've already built. And the order book backs this up. They closed FY26 with 3,000 crore in fresh orders, taking their total pipeline to nearly 9,600 crore over the next 4 years. Growth is also getting more diversified and they have got fresh export orders coming in from energy storage plus a growing passenger vehicle business, all of which reduces how dependent they are on the commercial vehicle cycle. The risk here is real though. Margins are still weak, debt is high and a large chunk of revenue still comes from the truck industry, so any slowdown there could delay this recovery. Now stock number 7 on the list, which is Go Fashion India. Most investors looked at Go Fashion's last quarter, slowing growth, weaker profits, negative same store sales and walked away. Promoters looked at the same numbers and bought 23.6 crore more shares from the open market. So what does the company actually sell? Go Fashion, which is also known by its brand Go Color, sells women's bottom wears, trousers, leggings, joggers, plazos. Unlike trendy clothing that goes out of style, this is something people buy again and again throughout the year. The stock currently trades around 350 rupees. And here's what promoters might be seeing that the numbers alone don't show. The company has actually grown well beyond leggings. Nearly 70% of revenue now comes from higher value items like trousers and joggers. The problem here is that their smaller stores simply can't display this wider range properly anymore. So to fix that, they are shutting undersized stores and replacing them with bigger 700 plus square foot stores that can show the full range, aiming to nearly double their total retail area over the next 5 years. And the underlying business is genuinely strong. 95% of sales happen at full price, barely any discounting. And a typical store pays back its cost in just 15 to 18 months. And the market opportunity is also huge here, with India's women's bottom wear market expected to grow to nearly 484 billion by FY29. So this looks less like a broken business and more like a fixable execution problem. The risk here is that this strategy is still early stage and needs another 1 to 2 years to prove out, and the business already ties up a lot of cash in inventory, which has been rising. Now let's move on to stock number 8, Shivalik Bimetal Controls. This is a stock that's already delivered strong returns and promoters still bought more. They added 0.46% to their stake through the open market even after the rally. So what does Shivalik make? Tiny precision components used in electric vehicles, smart electricity meters and industrial machines, the parts that manage current and heat safely. It's India's only fully integrated player in this space, supplying over 300 customers across 38 countries. The stock trades around 715 rupees. Now here's the growth story behind the buying. Demand for these components is about to grow a lot faster. Electric vehicles need nearly 3 times more of these parts than regular petrol or diesel vehicles, and India is rolling out 250 million smart meters which also need them. Shivalik has real technical strength backing this up too. They are among the very few companies globally skilled in a specialized process called electron beam welding, and they have developed 77 proprietary product grades over decades, which makes them genuinely hard to copy. Their current factories can already support over 1300 crore in revenue without needing major new investment. So future growth should only add up to profit. Now management even expects revenue from smart meters to potentially double again over the next 6 to 8 quarters. But yes, there are risks too. A lot of cash is currently tied up in inventory, and if demand slows or that inventory takes longer to sell, returns could come under pressure. Now let's move on to stock number 9, G&G Electronics. This is an unexpected winner from the AI boom, and no, it's not a chip maker. Promoters added 0.20% to their stake, putting in nearly 12.8 crore, even after the stock had already run up to around 622 rupees. So what does G&G actually do? Well, they buy old enterprise-grade laptops that big companies are upgrading, refurbish them to near new condition and resell them through their platform across 46 countries. Now, India makes up about 33% of their revenue, while the US and Europe together make up to 41%. So it's a global story now. Now, the real trigger here is AI data centers are consuming massive amounts of memory, storage and processors. That's creating shortages, and those shortages are pushing up prices of new laptops worldwide. As new devices get pricier, refurbished premium laptops become a genuinely attractive alternative for both businesses and regular consumers. Management thinks this imbalance could last through 2027. The company is scaling fast to capture it. For FY27, management has guided for around 25% revenue growth with another 50 basis point of margin improvement, and they have also said openly this guidance is deliberately conservative. The risk here is that this business needs a lot of cash tied up in inventory, and if prices normalize faster than expected, that advantage could shrink quickly. Now, let's move on to the last stock on our list, Sun Pharma Advanced Research Company or SPARC. Promoters put in nearly 150 crore through a preferential issue priced at 155.8 rupees per warrant. Real money behind a company that doesn't sell a single product yet. So what exactly is SPARC? It's basically a clinical stage drug research company. In simple terms, it doesn't earn from product sales today. Its entire value depends on whether its drugs succeed in trials and eventually get approved or licensed out. The stock currently trades around 266 rupees, valued at nearly 8,600 crore rupees. Here's why 2026 could be a genuinely big year for this company. Their oncology drug, SBO 154, has already entered phase 1 trials across the US, India and Australia, and it's progressing on its schedule. On top of that, SPARC could receive something called a Rare Pediatric Disease Priority Review Voucher, which is an FDA incentive that companies can either use or sell. These vouchers have recently sold for over $100 million. Now, the company is also getting leaner without slowing the science down. And the balance sheet transformation is genuinely dramatic. Reserves went from a negative 253 crore in FY25 to a positive 1,300 crore in FY26, mostly because of this fresh capital. Borrowings did rise to 559 crore, but overall the company now has a much stronger base to fund what's coming. The risk here is the biggest on this entire list. SPARC has no stable revenue today, and everything depends on trial results and regulatory decisions which can get delayed or rejected without much warning. So that's the 10 stocks with 10 completely different stories. Now I'll say this clearly because it matters. Promoter buying does not guarantee you a return. It should never be the only reason you buy a stock, but when the insiders start buying more right before earnings season, that's usually a good reason to go deeper and actually understand what's changing inside the business. If you want us to cover this regularly, tell us in the comments, and if this video helped you, then like and subscribe because we do similar deep dives for investors. I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.